very much. So I'm going to share my screen in a minute. So I'm Sebastien Barillot. I'm the founder and CEO of a company named Whysebird, which is a company specialized in fashion and luxury, and we operate in all the supply chain environments. So let me take you through a few changes that happened recently in the supply chain.
We need to get your camera on, Sebastien.
Yeah, of course. I cannot.
All keen to see you.
Yeah. I can't open it.
Okay, we'll get.
The host has stopped. So yeah, maybe on your side, if you can help me. Yeah. Okay.
I'm hoping that Rowan can. Yeah,
perfect.
Brilliant.
Here I am. Hi guys.
Away you go.
Now you can see me. Okay, perfect. So just before starting, maybe diving into the supply chain changes, let me give you a little bit more about a context. So changes happened a few months ago, especially in Hong Kong. You know, there were like a lot of protests, and the country was blocked for many months. And in the fashion and luxury, so we used this angle of fashion and luxury angle, and there was like a massive impact on our side. So we had all stores closed, and the result was like a loss of like several millions of pounds, because as you know, fashion is very big in Asia, and China is roughly accounting for like 30% of all sales of like global companies. So that started with this impact in 2019, mid 2019. Then Chinese New Year happened in early 2020. And at the same time, you know, we had the first sign of COVID. And that's why, you know, a lot of people worked. There's a strong community, Chinese community in Italy. So a lot of people moved back to Asia for Chinese New Year. I came back to Italy because a lot of factories employ Chinese people. So that's why the virus started also in Europe, in Italy, and impacted supply chain also in Italy, especially for luxury, where mostly the 70-80% of the production are made. And in parallel, we had Brexit that started in December last year. So that was quite of a challenging environment. And I would say that COVID and the Hong Kong protests had a massive impact in hundreds of millions for several brands, especially in the UK. So what has happened? I don't know if you heard about this, but 400 people, like designers or retailers, etc., signed a letter to and sent a letter to Boris Johnson early this year, claiming that the UK fashion is at risk because of Brexit. So the UK fashion is more than 35 billion pounds revenue. So it's more than fishing, music, film, and car industry combined. And the whole supply chain in the UK is more than 1 million people. And the main partner of UK is Europe. So there was a lot of concern. There were a lot of concern raised and addressed to Boris at that time. So in terms of impact, so COVID. What COVID has brought to us is like that many companies have closed. So 2,000 factories have been closed, 3.5 billion orders have been cancelled, and more than 4 million workers have been affected by COVID, for instance. So a lot of events were cancelled. Also, a lot of stores were cancelled, headquarters, a lot of operation has to be put on hold. There was a massive impact in terms of finance, loss of revenue, order cancelled. A lot of stop and go in terms of production, so it's been quite of a nightmare. And also an impact with Brexit, with COVID. It's also at people level. There's I would say that a lot of anxiety started to grow amongst people. Is my company solid enough? Will we go through that? Will I be made redundant? Will I maybe lose my job? So then also having the flexibility to work from home, having a hybrid model, etc. People being put on furlough. So all of that started to really challenge how people were receiving messages from the company, and also understanding if they were like trust or not in their organization. So what I would like to focus on in the few minutes we have together is on 3 pillars that are really the trends, I would say, for how our supply chain can absorb and bounce back with all those events that I've explained a few minutes before. So I think we will focus on 3 things: people, the people aspect, the digital aspect, and the sustainability part. In terms of people, Gen Z, like those new people working with us, this young generation are really driven by one thing, is purpose. So it's very important for them to know what they do, why they do things. Every morning they wake up, they want to have a sense in what they do. And you can see if you are looking at different websites like LinkedIn or other like a job search, etc. There are more and more positions referred as like chief purpose officer or well-being manager or inclusivity manager. So there are a lot of companies who start to really push this this purpose thing. So it's very, very important that we have people, especially at that time where people are at home thinking of their situation, where they're heading to, etc. But people ask themselves questions. So it's very important, I think, for brands, for companies to rethink and make sure that purpose is at the center of the equation. That has a strong impact also on well-being. And we were talking before we started this session about the fact that we are at home, we are less active. So how do we manage our energy? How do we manage our mental energy? How do we manage our spiritual, physical, and emotional energy? So well-being is also seen as a massive trend in terms of how companies will take care of those parameters. And of course, the blend between working from home or working at our office. So there will be this kind of hybrid model. So where do we put the cursor, etc. So will be really impacting also for people. And as leaders, also an important thing is to be aware of that. We have to be comfortable with ourselves first. We have to be at home. So we have time to pause, reflect, and being comfortable with ourselves, because if we lead people, and we are all leaders, whatever we have a badge or we haven't, we all influence people. So if we want to make sure we can drive our teams globally or people around us, we have to make sure that we're comfortable with ourselves so we can take care of others. So let's being selfish first, making sure that we are good with ourselves so we can take care of our teams. And also an important thing is how we can prepare better our leaders, how we can help them to communicate in this environment, which is new or different from what they've known, and how they can find values and drivers to motivate their team and help their team to change also. So a lot of work also on leadership and collaboration. And you will see that those values, those things, those important features will resonate with other topics, especially during the sustainability part that will take you through. And here we are. We are unfortunately not seeing the full picture. Maybe I can reduce it a little bit so you can see. So in this picture, you can see that the father is telling his kids, yes, the planet got destroyed, but for beautiful moments in time, we created a lot of value for our shareholders. So basically, there is no planet B. There is only one planet. So how can we be more mindful on how we bring purpose and how we develop, in my industry, for instance, or in the other industry, material with low impact. So customers are asking for more purpose and also more sustainable features. So wherever you produce in China, in Europe, in the US, there's a strong push at the moment that brands need to bring more purpose and needs to bring more positive attributes in what they do. So positive attribute in the products we develop with lower impact material, but also agriculture, in terms of agriculture, how we manage water, how we manage land, how we manage pesticides, etc. How we manage resources. So how we manage electricity, water, and also all around air emissions or noise emission or carbon footprint. So all those topics are getting really, really important. And I don't talk about also animal welfare or impact on people or societies. So what is important is always to define a vision and then a strategy. So starting with a bold commitment for those brands and those company, what is my vision? And there's already a framework. So in 2015, United Nations Organization has defined 17 sustainable development goals to end up poverty, to manage better resources, to take care of biodiversity, etc. 17 points that will help us to be more sustainable by 2030. So those are the goals. So that can help companies, that can help people to define a bold commitment aligned with this strategy and this vision of the, Then how we can define your strategy, how you transform that into, translate that into operations and actions. to avoid greenwashing and just doing like more transactional or opportunistic ways of doing. And just a quick focus on sustainability. I would like to talk about circular economy. And I know that the Ellen MacArthur Foundation is really strong at this level. And they define circular economy by basically lowering your inputs. I don't know if you're aware of, but in the UK, every year, more than 300,000 tons of clothing are destroyed or put in landfill. So basically, it's like more than 140 million pounds. This money can be used to, for instance, boost job creation. And that's also linked to something which is important, is like inventory. All the inventory of companies, all the products that we have produced that we are not using, or materials or raw materials we are not using. All this money, all this sleeping money, that stock can be used to maybe boost the economy. Circular economy can be also doing more with less. And we all know the old concept of reducing, reusing, recycling. Our grandparents were already doing that. But also, how can we embrace the new part of innovation, redesigning, repurposing, remanufacturing? And that could also, if we switch this mindset and we think about how we can embrace the new, can lead also to create more jobs in the UK. The important thing is to define the steps in how we change mindset. So I think what is really important is to educate people, spend more time explaining what is sustainability, where to start, then raising awareness. And once we have raised awareness and people are more comfortable, we can define action plan. And then we can drive that with ambitious goals. And what is important is that the ecosystem is quite wide. You know, we can talk to governmental bodies, we can talk to retailers and brands, facilitators, like NGOs that can be also involved, universities, designers, logistics companies. So it's a massive ecosystem that they all play a part in this equation. And the key thing is to share knowledge and make sure that we collaborate and we develop partnership. So that really asks a shift in mindset and how we can break silos and work all together. So just to finish on the last slide, I would share with you is about digital, which is also a massive trend. And we see that since people cannot travel, you know, we have our budget or business trip budget are pretty flat. So more and more events now are virtual. So there's our example in my industry, for instance, a famous fair called Première Vision. Everything has been moved to digital, and more events are this way, the Oscar recently. And the boom also of e-commerce. E-commerce in 1 year, in 2020, at the end of 2020, e-commerce has reached the projection of 2025. So we had a massive boost of e-commerce. And what is interesting is that e-commerce is also linked to more specific things, for instance, in fashion, 3D modeling. So is how we can modelize product instead of developing products physically. So what is interesting is that those two parts, e-commerce and 3D modeling, use the technologies of gaming entertainment. So we play with the same gaming technologies that are used in games to develop products and apply it to business. So it's a very good example of how we can break silos. And the aim also with e-commerce booming is how we can use the same approach of gaming and keeping people entertained and more connected on the platform of a brand or company, so that we create more traffic and we retain customers. I would just add also to that the importance also of AI. And AI, for instance, in the way that AI will not help, I talked about inventory. You know, we have a lot of dead product or dead material that are sleeping, you know, in our warehouses or at suppliers, etc. AI will not help us to fix it, but AI can help us to manage it in a better way, because our brain has limitation. But if we use AI, we'll be able to forecast in a better manner what we need to buy in terms of material or finished product. And also it will help us to optimize orders, because we have a crazy amount of information in terms of company profile, minimums of orders, etc. So there are a lot of data that are processed by humans at the moment. So how can we integrate AI to optimize that? And I know that there are a lot of works moving in that direction. And fashion and maybe luxury is not the most advanced, but we are definitely looking into that. So that is for me, Andrew. Thank you for the opportunity. And if you're interested, you can visit our website, whysebird.com. And we also have a podcast, The Must, where we talk about all those topics. Thank you very much.
Fantastic. Thank you so much, Sebastien. And for anyone, that was a late joiner to today's webinar, Sebastien Barillot of Whysebird, really kind of, I suppose, setting out the big picture for us of the sort of changing business landscape, the changing shape of supply chains across the world, before we start very shortly to dive into the nitty-gritty detail of exports finance. But I think I'm sure come back to you, Sebastien, to drill down into some of the links and the implications of those trends in the Q&A. I have to say, from West London business perspective, always delighted to see someone putting such emphasis on the environmental sustainability challenges of our time. Just last week, we launched Race to Zero West London, which is our sort of supportive effort for the UK government and UN's Race to Zero campaign ahead of COP26 this autumn. Now, without further ado, the baton is going to be passed to Adrian Innes of Finpoint, who is going to, as I said, start to get us into the nitty-gritty of export finance. So over to you, Adrian.
Hi, good morning, everybody, and thank you very much, Andrea. I'm not too sure about getting into the nitty-gritty. I think the key thing is to look at what Finpoint does and how we can actually help businesses secure finance. So whether that be trade credit, cash advances, purchase orders, receivables, discounts, term loans, or other types of business finance, trade finance is not unique to just trade, across the world. It's also, involved very much in the UK, and to look at where Finpoint sits and how we help businesses, being very much partnered with a lot of Chamber of Commerces and that up and down the UK, the FSB and UK Business Finances. We are a platform effectively to support those who apply through the mediums to source out different funding opportunities. So we have 136 different funders on panel. And one application completed on the platform allows you to engage with, somebody like myself, 35-year banker, 20 years RBS, 15 years Clydesdale Bank, and peer-to-peer involvement as well, to allow us to have those discussions about the purpose, understanding the true purpose of why people need to borrow money. And generally most applications come in relation to its cash flow, and the cash flow relates to the balance sheet. Is it your debtor trade days, work in progress, credit, whatever, and understanding the true purpose of why you need that money. And trade finance is no different to any other purpose for needing to be able to fund your business. And Sebastien talked about the supply chain. Probably I'm leaning more to actually the payment change and the payment terms of how you get your money back. So by using the platform, it's very much impartial advice that we give to help borrowers secure the right kind of funding. And it's truly understanding the purpose of why the borrower needs the money to make sure that the product is fit for purpose. Do you put in a revolving credit facility? Do you put invoice finance? Do you create credit terms, supply terms? What's the actual purpose of the borrowing, and truly understanding your cash flow cycle. Now, most businesses we speak to probably don't understand the cash flow cycle. The business owners are immersed in the minutiae of running the business on a day-to-day basis, and very seldom do they take a step back to actually look at the financial implications and the cash flow implications of their business to actually allow them to continue to trade. When we talk about 136 funders being on panel, that ranges from your high street banks. So your HSBCs, your Lloyds, your Barclays, your NatWest, your RBSs, your Clydesdales, to the alternative lenders. Now, the alternative lenders have really come into play since 2008, 2009, where they're offering a true alternative funding solution, to borrowers that are needing funding solutions to support their business and grow. If we move on to the next slide, we've been through, the past 14 months of pandemic. Civils has come to an end, Civils and Bibbles, which is a government-backed loan scheme, and was replaced by the Recovery Loan Scheme back on the 6th of April. Now, we know that most funders aren't accredited for the scheme yet, other than, the high street banks. And we anticipate there to be 50 or 60 accredited funders on this by the end of this month, and then lending. So we've got a bit of a hiatus at the moment where, the banks are going to be involved in lending through the recovery loan scheme, but it's no different to, the EFG small firm loan guarantee that was introduced many years ago. So how attractive is it compared to, the civil proposition that was previously there? Types of funding that we look at, I suppose, is, I'd often use a terminology that as long as it's legal and legitimate, we will have a funder that can consider funding it on debt serviceability. So the ability to actually prove that, the business is viable, and therefore the ability to actually repay that. So from asset finance, business loans, invoice finance, property, trade finance, etc. And R&G tax credits there as well, which are a big incentive to reclaim. What I've found in the last sort of 14 months is, how innovative businesses have been and how they've had to change their modus operandi in relation to nobody's walking through the shop floor at the moment. They're having to actually use digital platforms to actually sell their services online and their products online from that side of it. On to the next slide, please. So just a summary of the government support, 75 billion to 1.6 million of small businesses through the scheme. The majority of that was obviously taken up through the bounce back loans at 46 billion there, but these schemes have now come to an end. So it's about having the opportunity by using the Finpoint platform to engage with multiple funders. So, the proprietary technology allows from one application being completed for us to match you with half a dozen, 4, 5, 6, 7 different funders. And then we mediate and engage on your behalf, which is a completely free of charge service. And when I mean free of charge, how do we get paid? I hear you asking, is we get paid by the funder. So if you were going to HSBC wanting to borrow £1 million and HSBC were going to charge you 1% arrangement fee, so be it. If you come through Finpoint and we place that deal with HSBC, HSBC will still charge you a 1% arrangement fee. They will just pay a proportion of that fee to ourselves. And that is their cost to originate through the platform. So the number of applications we're generating on a daily, weekly, yearly basis is sufficient enough to say we have a supply and demand issue. Certainly with regards to the government schemes, the banks would always be your first point of call. There was no funders out there funding the bounce back loan schemes unless it was your existing bank and your existing, bank provider for who you were transacting with. So these slides will be provided, so I won't go into the detail of civil and recovery and the differentials between them. I think one of the key points about the recovery loan scheme and what was announced by UK Business Bank is funders are allowed to take a view on 2020 performance, taking cognizance of the pandemic. So what they're going to be doing is looking back to 2019 and then looking at projections from 21 to 22 and how are you going to recover, how you can actually return to the profitable levels and the turnover levels that you've been previously. I've been through a few recessions, depressions, whatever you want to call it in my time. And what I found with the most innovative businesses is that a turnover could halve, but their profitability could increase. That's because they've been more focused on their overheads, their cost of sales and the overheads that they're actually paying and making sure that they're reviewing them. Turnover has never been key in the business. It's important, but profitability, the net profit, the gross profit that you're making is absolutely key, because profit never pays the bills, cash pays the bills. And that comes as nicely back to obviously trade finances. It's actually understanding the cash flow cycle of your business. How long does it take from you buying initially raw materials, converting it into the product, shipping it to the destination, and then getting paid by whatever method of payment that you need, from contingent obligations and liabilities that you may have in the process there. Moving on to the final slide, please. So what do we do? I suppose is, we are completely independent. We work very closely with UK Business Finance, we work very closely with FSB, and we work very closely with a plethora of Chamber of Commerces, up and down the UK, which is, where our origination source comes from. But, we have experts that are available to give advice about who to speak to. The number of funders that we work with, we will hand pick and match make to make sure that you're getting the greatest opportunity to speak to a number of funders and to make sure that the product is right and it's fit for purpose for why you need that money. You know, I've seen some people borrow, you know, a retail shop, for example, borrowing over a 5-year term for stock. Well, that stock should be turned over within 30, 60, 90 days at a maximum. So therefore it should be able to repay that and continue to use that. So it should be a revolving credit facility that's being utilized to fund what they're looking for. So it's making sure that you have the right product at the right price and the right funder. And with 136 funders ranging from the high street banks to the alternative funders, we can generally find a solution for most businesses, even new starts from that side of it. So I'll sort of end there and obviously look forward to, you know, a detailed Q&A that we can get into some detailed debate about true funding lines.
Fantastic. Thank you so much, Adrian. I have to say I have lots of questions that I've been noting down that I'm keen to ask you, but I'm hoping that those tuned into the webinar will make full use in the next 15 minutes or so of the chat window to start posting your questions for our panel. So do make use of that. One question I'm going to put to you, Adrian, but right now, before we sort of move on to our next panelist, is I haven't yet been onto the Finpoint sort of platform to explore the user experience, and I just wondered if I was to log in there for the first time, would I find a particular part of the platform that is oriented around trade finance? What am I searching for as a kind of new user of your system to find the right financial products in this space?
Yeah, so there's always a dichotomy between asking too much information that puts the borrower off and asking too little information to actually truly understand the purpose of the borrowing. But when you log in, you know, it'll probably take you about 3 to 5 minutes maximum. It will be asking for the purpose, you know, why do you want to borrow the money? Then there'll be a drop-down section in relation to trade finance, to invoice finance. And if you're wanting to raise money against purchase orders or whatever, there's a drop-down box there. Then there's a box for where you put your project description. And what we've got to remember is, you know, when you initially log into our platform, the information is completely anonymized. So funders will see the reason you want to borrow money. They'll see the amount of money you want to borrow, and they'll see the term that you want to borrow the money, and they'll see that project description. They will not see the company name. They will do no credit searches at all. The only way they'll get access to the full detail and the full suite of information to assess an application will be when they request a connection with you. If you then connect with them, you know, that full information is fully disclosed at that point. So you're in absolute control in who actually sees your information. I think the biggest and the key thing is the project description, making sure you put it in the fine detail of what you need. And that's where we come in to add value to it. We'll have a look at the financials. We'll have that conversation with you, say, well, what's the real reason you need the money? Because what we're trying to do is entice funders to request a connection with you and then mediate on your behalf. And we can be as involved as much or as little as the borrower wants us to be. The borrower may think they're confident enough to engage with multiple funders, so be it. If the borrower wants to use our service free of charge to allow us to engage with the funders on your behalf, then absolutely from that side of it. So very simple application, but if you were going to HSBC, you were then going to Funding Circle, iWalker, Nucleus, Ultimate Capital, Ultimate Finance, and you were filling out multiple applications, these funders may be doing some soft credit searches on you to start with. Whereas with our package, there's no credit searches done at all until we've effected that connection and we've then authorized the borrower, the funder, to obviously then look at the financial information and start doing its due diligence.
So it's enabling a bit of soft testing of the market before you get into that sort of closer relationship with the potential funder.
Yeah, so the proprietary technology allows that matchmaking. So it allows us to home into those funders who actually have an appetite and the ability and the understanding of the actual business itself to fund fit for purpose solutions.
Fantastic. Lots more for us to talk about a bit later on, Adrian, but we're going to once again pass the baton, and this time to Hitesh Patel of UK Export Finance, who's going to give us a bit more of a flavour of UKEF and what it can do for UK companies in the EU and further afield. So over to you, Hitesh.
Thank you, Andrew. And just to introduce myself, I'm Hitesh Patel. I work for UK Export Finance, which is the government department, essentially the government's export credit agency. I'm just really following on from Adrian's comments around the availability of finance. Our role in government here is essentially to support viable exporters who have viable export opportunities abroad that may be struggling to get the right level of finance or insurance package from their providers. Our primary role there is to engage with scheme participant banks. So that's one key element that I'd like to get out there, that the big five banks, Barclays, HSBC, Santander, RBS, NatWest, and HSBC are scheme participants. One of the key things I would say to you here is that if you are looking to do exports and you are looking at struggling on the right level of finance support, the key message I would say to you is talk to the right people within the bank. So have a conversation with your relationship manager at the bank and ask to be introduced to the trade finance person at the bank. The trade finance person will be very well versed in how to engage with our department to ensure that if they need our support, that they are able to approach us for it. And they won't always come to us for support, but if for whatever reason they find that the security that you're able to afford, etc., didn't meet their appetite, etc., or let's say, for example, you were doing an export, and even if it was as low as, let's say, £5,000, but the bank was saying we can only lend £2,500, we as government may be able to step in to support the remainder £2,500 by providing our guarantee to the bank. So just to reiterate, very important that you talk to the right people at the bank. Quite often, exporters actually miss out on opportunities because the right conversations haven't been with the right people within the bank. And, you know, Alan will tell you, Alan Ridges will tell you that quite often, most bank managers in domestic branches, etc., have never really heard of UK Export Finance, the government department, but the trade finance person would have. So by coaching the relationship manager at the bank would be a very good thing. And sorry to labor on that point. What do? We're able to provide support for anything ranging from bank guarantees, tender bonds, performance guarantees, etc. Most type of bank guarantees, apart from VAT guarantees, for export opportunities. And we're able to support a bank with up to 80% of their exposure to your business. So, for example, if you needed a bank guarantee for £10,000, we may be able to support the bank with up to £8,000 of their exposure to you. And similarly, also on our working capital solution, we're able to support any working capital requirements that you may have that the bank wishes to structure with you on a trade finance basis, etc., to enable you to do your exports, by also providing up to 80% support to them on that working capital requirement. We don't dictate to them how they do the lend. So, for example, they may want to structure it with a trade finance package or a more lenient package, which is more suitable for general exporting. So there is this working capital solution. Now, the bond support scheme, which is for the bonds and guarantees, and the working capital, export working capital scheme, of old have been contract specific, i.e. a viable UK business is contracted with an overseas party and has at least 20% UK content. Now, that UK content can be not just profit, but value add to the UK economy. So from an invoice, let's say of £10,000, providing that you can allocate 2,000 of that to UK content, let's say profit was 15%, UK staff, freight services, insurance, widgets, whatever it was, we're able to support. And it's not there just for viable, as in physical goods. It can be intellectual property, IT services, manpower service, whatever that you're actually exporting out of the UK. So on that scenario, with the bank, we're able to support up to 80% on either the working capital or bond support scheme, which is more contract specific. However, recently the Prime Minister announced that we have got a new facility called the General Export Facility, which, you know, for the participants on this call may be more relevant. It's a more flexible facility that allows the 5 scheme participant banks to afford a more general facility, non-contract specific, to support the bank with up to 80% support there. And in order to do so, a business should have either done 5% of exports in each of 3 years, previous 3 years, or 20% in any one of those 3 years. Has to be a viable UK business established and has got at least those turnover brackets. The other criteria that we have here is that the bank must take at least 20% exposure against your business. And therefore, hence why I would suggest having a good conversation with the bank manager and related to the trade finance person. So those are the 3 main products that we have delivered through the bank. The working capital scheme is there for 5 up to working capital requirements for up to 5 years, but typically the banks will provide that on a rolling yearly basis and or structure it according to your individual needs. And the banks have delegated authority to make their own decisions and put that through to providing certain criteria met to go up to a UKEF exposure of £5 million on an altered delegated model. On the bonds and guarantees, that also is true. However, typically the bonds and guarantees requirement is, you know, a maximum of 3 years. Not to say that we won't consider anything longer term, but those are the typical parameters by which the banks have a total delegated authority. The next point I would make is that quite often people are scared to do exports. So again, one of the things I would say there is a trade finance person at the bank will be well versed with showcasing the risk mitigants that are out there to mitigate exposure that could include trade service products that the banks have, but also quite often insurance is a good mitigant where an overseas buyer wants to buy more and more of your goods, but you're getting a little bit concerned about the credit exposure out there. That is where, again, government can come through. And in this case, you don't have to come through a scheme participant bank. Insurance is something that we can look to provide directly through us. And ordinarily, we would not be able to look at insurance in OECD countries. So the first requirement there is that you actually go to an insurance broker to try and get insurance cover. If you cannot get the insurance through a broker, currently we are able to look at nearly any part of the world, providing that we are also on cover for that part of the world. And we are allowed to also look at OECD countries whilst the rules have been relaxed because of COVID. Yeah, it's a very, very good way to mitigate overseas exposure and allow your business to grow. Just to add to those products that we have, again, as Adrian was saying, how do we earn our income? Our role is there not to be a tax burden, but not a burden to the taxpayer. Therefore, what we do is where we provide support to your bankers for supporting your business, we revenue share with them only the interest margin above their cost of funds for the portion that we support. And therefore, you should see no difference in your part. We don't get involved with any of the arrangement fees. We don't get any fee for that element. It is literally just the interest margin above their cost of funds for the portion that we support. So if the bank was going to charge you 3% ordinarily, they will still charge you 3%. We would just be compensated by the other piece. With regards to the insurance policy, when you apply to us for insurance, we will quote you the insurance based on the country and the party exposure abroad. We don't add any profit element to our insurance package, and hence, again, the reason why we prefer you to go to the private sector, because we're not there to compete against them. We're just there to complement the private sector. So in real summary, what I'd like to articulate here is that we as UK government are here to support your business where there is a viable export opportunity. We're not really geared to any specific sector or amount. We can look at very small businesses all the way through to very large businesses. And we are reliant on working with scheme participant banks that have at least 20% appetite against your business, and where you can demonstrate that you are adding value to the UK economy by having at least some form of UK content to the tune of at least 20%. So in summary, that's what we are. Our details can be found on gov.uk, and if you put export or find export finance manager, you'll be able to get through to us. And if you need us to supply slides, I will make those available to Lisa after this after this conference.
Fantastic.
Yeah.
Thank you so much, Hitesh. I'm going to ask all of our panelists to switch on your video cameras, so you're at the ready. The Q&A sort of area is open and live for any questions that you want to put to the panel. And I think you preempted, Hitesh. In fact, the first question that's been asked of will slides be available? And just to reinforce what I said at the top of the hour, yes, we'll be circulating slides from all panelists, and of course we're recording the webinar today, which will be available on YouTube within the coming days. Now, my first question, as we sort of wait for questions, hopefully trickle in from viewers, is I think probably to both Adrian and Hitesh, and this is I think sort of for the, I suppose, entry-level exporter that was perhaps sort of contemplating doing this for the first time. You mentioned, Adrian, the issue of cash flow, and I suppose ultimately it's cash that is going to be the driver behind folk needing to look at different sort of borrowing options. And you talked about the time from shipping through to payment being a critical consideration. Where do you see things go wrong in this regard? Sort of from the years of experience you've both got, what are some of the things to be thinking carefully about on that sort of cash flow piece as a new exporter?
I think with any cash flow piece, you've got to sensitize it to a certain degree. So when you're putting together your projections, you put it together at an optimistic 100% of delivery, then reduce it down to 75%, and then it's also understanding what the break even is on the business as well. And also building in delay mechanisms in there that may actually delay the payment terms for whatever reason. We've seen, obviously, during pandemic that, debtors are, paying from 30 days now going 60 days, 90 days, 120 days, because their cash flow cycle is actually impacted in relation to how they get their money in. So it's having a business cash flow model that is agile enough and that you're close enough to that you can change. And it's working with a funder that has that revolving credit facility for you that is allowed to be obviously changed with a change in circumstances that may happen during any sort of economic condition or change in cycle.
And you, from the sounds of it, you seem to be suggesting there's need to err on the side of caution, or certainly sort of plan for some of the more pessimistic scenarios that could unfold.
Well, I think there's a lot of businesses I've seen over the year that don't understand what their break even is. So if you don't understand what your break even is, how do you know how many widgets you have to sell and what your finance is going to cost you and the trade cycle is going to be for you to actually make any money? And a lot of, directors of companies rely on maybe a financial accountant or their accountant to pull these figures together. And then when you question them on the assumptions behind the cash flow, they don't really know them. It's difficult to trust a new start business, for example, or somebody's getting into a new market on exporting where the principal you're speaking to doesn't really understand the financial projections that he's talking to you about. Because predominantly banks will take a view on the principals involved in the business. They're looking at the personal acumen and the business acumen and what has that person done before. It's not a drag and den scenario, but they are looking to see, what experience have you got in the marketplace that you're actually going into. And, a business that can't tell me where their break even is, I'm slightly concerned, because if they're just relying on accounts to be reduced 18 months, 9 months, in arrears and not into the detail as it needs to be, then, it's difficult to trust that business that can be a viable business.
Thanks, Adrian. And Hitesh, what's your take for new exporters on this sort of cash flow issue?
Yeah, look, Adrian makes a very, very valid point. I mean, I have a personal friend of mine, and I can't help myself. I've done 35 years worth of banking, and one of my key questions to him in his journey into new business was, do you know where your break-even point is, etc. Now, bank managers of all sizes are geared up to sort of give guidance on stuff like this, and also accountants, etc. is getting that right level of support out there in what you don't know, but it's important that you do learn what you need to learn in order to grow your business. And as far as an exporter is concerned, more specific to the sort of my background in trade and trade finance, one of the key things is I would say to people, never be afraid of looking to do an export. That's the first thing. Yeah, there are risk mitigating circumstances that can aid you to do sales very quickly. Well, we do it all the time. You know, you could buy something off Amazon, you click, and off it goes. You just hope your goods get here. We don't think about that yeah. If we look at that same model in sort of doing an export, etc., well, what is it that, you know, if I send my goods abroad, am I going to get paid? Well, I'm worried about this. So have that conversation with the bank manager, look at the cash flow need to service that contract with them, and get the right level of package one to get the funding there. But secondly, how do I sell my goods abroad? Let's say let's pick one, India or Africa. Two continents where quite often trade service product like sending documents through the banking system could be a very good risk mitigant, because then through that process you are actually taking control of the shipping documents that accompany the goods, and therefore you've got control over how they're released to the buyer, and that can be done by the bank the other side. They obtain the debit authority from the client before they release the documents for them to go and pick the goods up. A banking question and good advice from a bank, and the bank can help do that cash flow. For example, in Sebastian's case, where he was giving this about the fabrics, etc., it's about how do you look at safely doing a transaction and cash flow building around that. Have those conversations with the bank. We as government can also support the bank on that sort of level of exposure, and there are insurance products to sit there. Andrew, I hope that sort of answers it.
That gives some good hints and tips there, I think. I'm going to take us to a sort of big picture.
Andrew, could I jump in just for a slight second and on a question for Hitesh? Is what I've found over the more recent years is people don't know who their bank manager is. You know, they've gone to call centres, they've gone to numbers as opposed to names. There's more junior bankers in there that class themselves as relationship managers, but they're call centre answerers. So, you know, to help the public listening to the call and, you know, on the webinar today, how do they get through to somebody who will actually, because you spoke about quite a low level entry, 2,500, 5,000 up to 5 million. I'm more concerned about the 2,500 to 50,000, which, you know, how do they get in to speak to the right person? Is that something you can assist them with?
Absolutely. And look, Robin on the chat has actually put, my business is below £500,000. You know, I don't have a relationship manager and have no in-depth. Yeah, all of the 5 banks, and I totally agree with you that below £6.5 million turnover, etc., more and more of the banks are going to a call centre model. Yeah, and hence why also, again, a lot of the local staff within the local branches are not even aware of trade finance within their own organisation, let alone UK export finance being there to support. So my guidance always, and I'm speaking as a former banker, I did 11 plus years, 14 plus years at Lloyds Bank and 25 at Barclays Bank. Yeah, so 2 of the big ones in the country. And one of the key things I would say there is it is important, even if you are in a call center, to look up who your, you know, through the websites, etc., who the trade finance staff are that cover that region. It's very, very important that you latch on to the trade finance staff. And in today's world, you're able to also do that through places like LinkedIn, etc. But what I would also say in that, so do the little bit of research through the company, the bank websites. Nearly all of them will have a trade finance part within their actual main customer-facing website. Through there, either go through to their actual trade service call center, which is different to their banking call center. So if you've got a problem with your checks or whatever, you'd go to a certain area. But all of the banks would have a trade finance or trade service.
So we've got to be persistent and accept that we might not have a relationship manager any longer, but there is an export finance team to plug into.
Yeah, absolutely. And look, the other thing that I would say there is that there are 26 of us around the country. And again, going back to Robin's point here, is that there are 26 export finance managers, of which I'm one of them, dotted around the country. Yeah. One of the things that we're able to do is each of us will have relationship with local export, the local trade finance people within the main 5 banks. So therefore, if you are struggling, reach out to your local EFM. I would suggest you do it through our customer services team initially, because obviously people like myself are more busier than the call, our help desk, and they would be able to direct you as well. So on our website, the customer service team would be able to, direct you through to either a local EFM.
Fantastic. I've got another question for you all from the from our webinar viewers, and this is from Gaboyega, who is asking whether there are opportunities in the digital space using new digital technologies to support trade finance documentation in new ways. I don't know whether Sebastien or I'm sure you've all got perspectives on this opportunity, but Sebastien, I don't know whether you want to come in first.
Yeah, so in trade, I'm not an expert in this level, but I would just want to bounce back on what the guys were talking about, and more the impact on supply chain also before answering on the digital part. What is interesting, what we see with Brexit is that, first of all, a lot of companies were not ready. So big corporation, we had a lot of consultants working with us for many years in anticipation to what level of documentation we needed to get to be ready. So think about it, a product, if you are a UK brand, your materials may come from different sourcing regions. So especially in fashion, so we can have a fabric coming from Italy, a metal accessory coming from Spain or from France. You may have like another part of it, a leather from France, etc. So all those materials need to come to the UK to be assessed, to develop prototypes, etc. And what we've seen is that there's some, I don't know if you're familiar with DPD, which is a logistic company, a French logistic company. So they shut down their activity for 3 weeks at the beginning of Brexit. So what happened? That has a massive impact. So talking about logistics, but talking also from the brand point of view, company point of view, some companies like maybe Burberry or other like brands in the UK were thinking maybe to open up new head office, not head office, but like small offices in France or in Italy to facilitate, what we call like the development stage, because you have a lot of back and forth through, borders. So that has a massive impact on strategies. Do you need to bring people to those locations? Do you need to recruit locally, etc.? And also I was in a webinar with a French brand called Veja. So they're like a sneaker company. They have grown exponentially. They are really successful. Their biggest market is the UK. So they have been hit really hard with Brexit because there are a lot of issues with customers shipping, products and returns of products, etc. So they're thinking about opening up maybe a bonded warehouse in the UK. So, all those impacts that we're not especially thinking of are very, very important also.
And so working in both directions there as companies look at new legal entities, sort of structures and where activities happen.
Exactly.
Moving in both directions across our new borders. I'm going to come back to this, the question from Gabiega for Adrian and Hitesh's view on how you're seeing sort of documentation become more digital in this trade finance space. What's your take?
So for me, I think the digital innovation in the fintech market has made the world a very small place. it's made it a lot more agile. As long as we can get around the legal complications of, digital signatures and such like, where there are some organizations, banks included, that are still not able to accept digital signatures on whether it's a guarantee or a bond or some kind of legal document. But certainly the innovation that you'll see from, businesses that have changed their modus operandi in the last sort of 14 months, it will put them in good stead in the future.
And Hitesh,
yes. Yeah, so digitalization of export documentation actually still is, in my personal opinion, quite in its infancy. Yeah, there are platforms out there that are being developed. I'm actually working with a business at the moment that's trying to showcase one of their platforms to effectively help a UK company and an overseas company create the contracts and all of the processes that go together with doing the trade, and almost digitalizing it to a portion. But certain things like transport documents still are not there yet. There's been talk for many years about digitalizing that element of it, but we're not there at the moment as far as I can see.
Yeah, that's interesting. I think we'll be watching keenly what this startup manages to bring to market, because it could be music to many folks' ears. I'm sure. Now I've had a question from Alan Rides, who, for those of you that have been keenly following this series, you'll know has facilitated the first two of these conversations, and that's whether you can tell us a bit more, Hitesh, on the GEF, the sort of general export facility that you mentioned briefly. You whetted our appetites for more information on this new scheme that's coming through, which I guess for particularly the kind of smaller sort of SMEs that have perhaps found it difficult to engage historically with UK export finance, this is a new avenue.
It certainly is. Look, the GEF does two things. The first thing it does, it simplifies the process for the bank, and it allows the bank managers to be a lot of bank managers understand. I don't know, some of the participants in yourselves included may have heard about the enterprise finance guarantee, which is really there that a lot of the lower tier bank managers, and I don't mean the businesses that they look at in the lower tier turnover brackets, would understand. Trade finance historically can be quite expensive for a bank to administer and implement, etc. structure. So therefore, sometimes offering trade finance in the true sense solution becomes expensive and therefore highly unlikely to be afforded to the lower tier. Yeah. GEF takes away a lot of that sort of process for them. It simplifies the process for them. And from a product point of view as well, from product and compliance point of view within the banks, it allows more flexibility and therefore should lead to more businesses being able to be supported quicker, efficiently through the bank. So the opportunity for smaller lends becomes a lot more doable because of the simplicity of it. Yeah. Andrew, I hope that answers that. But yeah, again,
that's really helpful. And I'm just that's making me, I suppose, wonder what are the interconnections, Adrian, between the Finpoint platform and the UK export finance kind of offer. I mean, at what point might I, as a small business, get a reasonable offer coming through on the Finpoint platform that perhaps needs additional underpinning from UKEF?
Yeah, I suppose this is a relationship I'd probably say is embryonic and very much will grow from this call today. So we have connections with the majority of the high street funders, but do we have direct access to the people that are doing the trade finance within there? And that's where we would go to our local connection and then ask them to point us to the right person to get the customer and ourselves speaking to the right person who really understands the product. But Hitesh and I are going to sort of pick up and sort of grow that relationship from here. So that's an absolute bonus for two of us, I would imagine.
Fantastic. Yeah, and I'd like to just say, look, I'll pick up with Adrian about the platform side of things, because again, to your point, Andrew, we are, as a government department, looking at some of these platform providers to see if a level of support could be underpinning their exposure to exporters. Yeah, maybe like from a portfolio basis, etc. But again, it's one of those discussions that we are working quite actively on. But GEF certainly, in my personal opinion, is one that could also be fitting for some of these other providers on through a platform. I hope
starting to fill that space, but yeah, sounds promising that the conversation is starting today. When Alan and I sort of reflected kind of some months ago when we were first putting together this series on some of the questions that we really sort of wanted unpacked, and perhaps some of the reasons we felt why SMEs are sometimes scared away from UK export finance, if you don't mind my putting it that way, Hitesh. Two kind of concepts came up as perhaps sometimes being challenging for SMEs. And the first of those, which I'm hoping you can unpack for us a little bit, is this idea of know your customer requirements. Can you explain when that comes into play at export finance, and what does it mean in practice?
No, very, very good. Okay, so the first thing is that because of all the three main working capital and bond support schemes are provided through your bank, we rely on the bank doing its KYC process diligently with its clients.
KYC, is know your customer.
Yeah.
All right.
Yeah. KYC is know your customer, and we would expect all of the finance providers out there to know their clients. Anti-money laundering, if it's to do with, for example, environmental and social implications, health and safety, all of these sort of things, we would expect the bank to already know its clients. And therefore, any interaction that comes through to government support will automatically be covered under that. However, quite often, a UK exporter, and this is quite relevant, even if you're a small exporter trying to reach out for the first time, if you're using an agent abroad, for example, to be your conduit to reach that domestic market. So, for example, the Middle East is a classic example of that. Dubai seems to be a very big hub for very good opportunities, and I might bring that up right now. Very good opportunities in the Middle East at the moment, including Saudi Arabia, etc., that are opening up quite very much so for UK goods. Is that quite often you may use a local agent in market. Therefore, for us as a department, we would do our KYC process in more due diligence on that agent, because quite often under the trade finance model, a bank may not do as much due diligence on an agent abroad as we would, or ordinarily do that as part of a trade finance transaction with an end buyer. So very important part, but we rely on the financial institution to do majority of that as a business as usual practice.
And so as the exporter, the know your customer, it's the end customer, the end recipient of the sort of goods that the due diligence is being done on. And what sort of due diligence is involved? I mean, you mentioned an agent. What would you be wanting to find out and have confidence in with regard to that recipient?
Yes. So, so as a business, one of the things I would say to a business doing their KYC is that, there are various credit reference agencies that you can reach out to just to do your normal Dun and Bradstreet, etc., or particularly if you're going to give credit terms to a party abroad. But if not, then what you do is work with your bank manager to look at other risk mitigants, as I said, trade service products that ordinarily, if you're going to do, let's say, a letter of credit, which is an instrument that allows you to do international trade or documents through the banking process, banks have screening processes behind the scenes for anti-money laundering, etc. But for a UK business to do its own KYC, it really is quite, for me, to look at common sense approach here is that if you don't know the party abroad that you may want to do, particularly if you're going to give credit terms abroad or reliant on not having control of the goods going abroad, to do some additional credit checks. Talk to your bank manager, the trade finance person who's best placed for that. But for us on the KYC, on the know our customer that we would do on an agent is, as a government department, we obviously have embassies all around the world. We have DI, Department of International Trade staff in country. And quite often we would either do our own sort of, without going into too much security detail, we have our sources to be able to do due diligence on businesses. For example, has a business lifted product from a sanctioned country before? Have they dealt in dual purpose goods? Have they been linked to unethical practices for, child labor and stuff like that. We look into some of that. For example, we quite often get, as a government department, to sponsor very big projects, let's say to build a dam or an airport, etc. We will do additional due diligence in all of the key parties concerned to that, more so on the agent, because quite often the agent could be tempted at thinking, you know what, I'll slip that in with no one will see, we'll pick up on that. Yeah.
This, for me, perhaps ties back to the point Adrian was sort of saying in terms of the use of the Finpoint platform and those sort of project descriptions that you were saying. So when when you're soft testing the market and describing your need, does this sort of know your customer piece start to come in there, or when you're a bit further along in the conversation with financial institutions, Adrian?
Yeah, I think it's a bit further along, because what you're looking at the project description is, let's call it effectively a teaser. It's a teaser to allow the funders to have a look at what the purpose is, how much you're looking to borrow, the term of it, an indication of the reason why you need that money. But we find most project descriptions are lacking in detail. And that's where we then have the conversation with the customer. We glean the information, we then update and add value to the project description. We're then able to articulate that much better to the funder and help them understand. And this is at a time when the funder doesn't know who the borrower is, because it's completely anonymized until that connection is affected on both sides.
And in that sort of wider marketplace for trade finance, those sort of, as an exporter, knowing your end customers, are those likely questions to come through in sort of due diligence?
Yeah, absolutely. It's again, it's the mitigants of the risk, isn't it? If you don't know your end customer, how do you know you're going to get paid? How do you know the legality of the actual contract you're dealing with? If there's a third party, is there any underhand things going with a third party? So, it's probably very easy in UK to understand your customer, know your customer, and do your anti-money laundering to a certain degree. But when you're looking at, European entities or worldwide entities, you do have to make sure that there's a viable customer there and follow all legitimate research angles to obviously identify your customer and get comfort on that.
Yeah, so Sebastien, from where you sit and looking through your kind of 3-pillar lens of the changing world of people, sustainability, and digital, what's your sort of take on these challenges? What are you seeing out there?
Well, just bouncing back to what Adrian was saying, what's interesting in the world where I operate is that the risk is not at client level. So we have to know our client to sell better, of course, our products. The risk is more on the supply chain, so it's more like upstream. So the brand is targeted. So in terms of risk of reputation, Hitesh was talking about social impact. So we do a lot of due diligence in this way. We have also protocols, etc., to ensure that we respect. And you might have heard like a BBC release in December, like a communication, a document around cotton trade and the way the community in China, the Uyghur community, was exploited, the new modern slavery. So the risk for brands is more, I would say, upstream. So we could be targeted, but how do we work with hundreds, thousands of suppliers, of providers globally? So how do we ensure that best practices are in place? So I heard what you guys were saying, that you target your client to investigate. We buy from a vendor that is making a product, but we can't only just talk to this vendor. We have to make sure that from a social point of view, environmental point of view, quality point of view, we have to make sure that we meet this vendor meets our standards, but also all the supply chain, which is quite organic. If I talk about fashion, for instance, so you can have 1-2 vendors doing the same product in different locations. Then you can have different people who dye or finishes the product. And then you can have spinners, you can have weaver, knitters, and it goes until farms level. So some brands build partnership at farm level, at cotton with farmers, etc. So the risk, I would say, in our industry is more upstream. And that's where NGOs, we need also to link with NGOs. Brands can be attacked by NGOs or exposed by NGOs, but then how you can understand, receive the message, and work with them proactively to maybe develop some partnership locally to not at the end exploit, the population, or like reduce, like, I don't know, the number of resources, and make sure that you are making an impact. So
that's a great segue into the second bit of UK export finance jargon that Alan and I were thinking could confound SMEs out there, and that's the whole space of environmental impact assessments. Hitesh, can you tell us a bit more about when they come into play? What type of deal and size of deal would you be looking for those to be completed on?
Yeah. Everything that we as UK Export Finance do will have a level of assessment done mainly by the banks. Again, I would reiterate here, because if there is work being done with trade finance solutions, then a bank will analyze that as part of its risk process. Yeah. What is the impact here? As Sebastien talked about, it's also reputational damage for a bank and even us. So for us, the main time that we are likely to get involved with environmental studies, etc., would be on more of the bigger projects. Yeah. So, for example, let's say, and I'll give you one. In the Middle East, we were supporting a water treatment plant. Yeah. As part of doing that water treatment plant, it logically tells me, well, if you're going to clean up affluent, well, that's got to be a good environmental aspect. Yeah. But no, you have to look at what other processes are going on behind the scenes to that. Is that what we are engaged with, and what the party abroad is trying to look at is what is the other negatives that might be created by a treatment plant? Is it going to then create a different type of environmental project, environmental issue? Sebastien talked about landfill, product being, material being put into, all of these sort of things we would get engaged with typically more on the bigger projects where we're looking to finance the whole package to an overseas buyer potentially. And those tend to be the projects that are over 30, 40 million pounds going up into the several billion pounds, So for example, if there was a dam being built, what is going to be the impact on the people that might be displaced in that field? Is there wildlife that gets displaced? Are there endangered species? Are child labor going to be? All of these other factors we get involved, but it's relative to the type of transaction. If we've got a company that's exporting widgets from the UK or services to the UK, well, widgets, is it safe? Is it going to kill someone? Are the standards good? We know in the UK, our manufacture standards and testing is really good, but in other countries they're not. But here, what if we were sending staff abroad? Because staff is an export. Are those staff going to be advisors, or could they be military? Are they going to be giving something to a country that's going to have an impact on people's lives? So we take the environmental studies and all of this very seriously, but it's relative to what the ask is. Yeah, but typically they're for the bigger projects that we're looking to sponsor.
So it sounds like situations where either the exporter is likely to have undertaken some environmental impact assessments already, or if they don't have that capability in-house, they might be pulling in a specialist to provide some extra support.
Yeah, generally speaking, certainly in my time at UKEF, what I've noticed is that companies in the UK are actually asked to do the environmental studies, etc., on behalf of projects that have been happening abroad. So that is the export. So our expertise actually does that. However, if an exporter has been asked to, let's say, do a water treatment plant or part of that process, then you would typically you typically work with the environmental studies that is done by the main sponsor as part of that process. To collate that documentation. It's like building a house. The surveyor will do the main piece, but all of the other parties will latch onto that due diligence that's been done at there, but someone will be overseeing that process.
Yeah, if I could, sorry, Andrew,
yes,
if I could
Sebastien.
add just one thing, is that you mentioned like having a consultant or having someone that can define the strategy. I think it starts somewhere in a company. It starts somewhere. You need to have someone, a team or a consultant, whatever, to define the basis, the concept, and then it needs to be embraced widely within the company internally, and finding people for whom it resonates would be the first thing. Same into your supply chain. We talked about a company and all its network, all our suppliers, etc. So you have to find people, and some people are more production related, for instance, and may not have those people. They're just here to produce and deliver goods. So how can you network and develop that concept, inspire others throughout the supply chain? Because it starts in the case of a product that you buy, it starts with the material. So how do you get to this at the farmer level? So that is very interesting, and I know that when I was working for Burberry, that was the whole concept, how we can go down the whole supply chain and inspire and develop networks, what we call of champions. And as trends, I think one of the killer today in most of industries, uncertainty. How do you know what you need to produce and not produce more, and then create inventory, and then all this money here, this dead stock, is money wasted that could be used for developing sustainable strategy or developing other project or employing people. So inventory will be really, really a key thing to look at. And I briefly talked about AI, but there are a lot of other options. And also in the world of fashion, is seeing fashion as a service, not as a product anymore. It's not, because we realize that a lot of people buy products and maybe 2/3 of what they buy is not used. They wear it once, and then it slips in their wardrobe. So how can we shift that approach and just rent something? So there are already players in the industry are changing the approach. You can rent something for a special event, or you can buy something, then sell it as a second hand, etc. So, or you can rent it to someone else. So there are a lot of new things moving in the industry to rethink and being more like aware and more conscious on how we manage resources. And that is a trend that we see in China, that is a trend we see in Europe, that is a trend we see in the US. It's global. So we have to move, and that's why if you are a banker, if you are a company selling goods or whatever, everybody's concerned. And that's a game that we all have to play. It's not a question of when we do it, we have to do it now. We have to move quick.
Indeed, a race to zero, as I said at the top of the webinar. That I think so neatly sort of ties back to a reflection of one of our viewers who asked a little bit earlier on, how on earth, with the level of uncertainty, are we supposed to plan for new financing when there's so much doubt? And this is a viewer, Youssef, who applied for a bounce back loan sort of back in May, June last year, but obviously started using it within the business like so many others on the expectation of a 3-month lockdown. Any broad reflections there from the panel in terms of the challenges at the moment of forecasting in businesses?
Yeah, I think the only concept or the only content we have at the moment is continual change. We should be coming out of the pandemic in the next couple of months. When bounce back loans were initially introduced, and great thing from the government to introduce so quickly, albeit it was 8 self-certified questions without any debt serviceability overview, which brought such a flood of the money to the market through the bounce back at almost 1.6 million of businesses funding for it. But we only thought at that point we were going to be closed for 12 to 16 weeks. And then all of a sudden you get lockdown 2, you get lockdown 3, and you get lockdown 4. And I think what it brings home is the point I was talking about earlier on in relation to your cash flow forecast, is do some sensitivity analysis on it. Now, again, if I go back to my old banking days, when base rates used to change considerably over the years, we used to put a 5% interest rate hike on to allow for affordability. And we also sensitized the turnover to 75% and said, would it still be able to actually pay the bills if those 2 changes were to happen? And that could be a negative way of looking at it, but you've got to look at and plan for any eventuality. You're never going to get it right. A cash flow projection is a projection. Therefore, there are assumptions, but what's the methodology behind your assumptions? And if we jump back to that break-even figure, what's the absolute bare minimum do you need to sell to be able to break even in the business? And if you know what that is, the devil in the detail in relation to your overheads and your cost of funds, and you're managing those costs, well, monitoring them closely, then, you can react quicker to implement change when you need to diversify.
Thank you, Adrian. I've got one more sort of quite technical sort of question or reflection that's sort of come in through the Q&A, and this is around that old favourite of the role of invoice finance. This viewer of the webinar is, reflecting on having been introduced, I think, by their insurance broker to an invoice finance company that was also able to provide insurance against non-payment. And I wonder whether that's a route, perhaps particularly for smaller businesses, that you've found companies going down. Whether Hitesh or Adrian first. Yeah.
I'll kick off, but because invoice finance predominantly, or if you go back 15, 20 odd years, had a bad name. It was almost classed as a lender of last resort. And the only businesses that used an invoice finance facility effectively were ones that were in trouble anyway and needed to leverage against the debtor book. I think when you're looking at invoice finance now, it's for all types of businesses that are emerging, growing and developing. And what they're finding is, and I touched on it earlier on about, people saying they need cash flow. And the cash flow is the problem, is that the debtors are no longer taking 30 days, they're taking 60 days, 90 days or 100 days. And what you find with a lot of alternative invoice finance providers is they won't necessarily do a search on the company who's borrowing the money. They will search on the debtor, and they'll look at the debtor ledger and see if they can get an insurance on the debtor. So it's not the ability for you to be able to repay, because they're going to claim the money from the debtor because of the insurance policy they'll take out. I think it's absolutely fit for purpose for the right business and the right product set, as is an overdraft, as is, asset finance, as in revolving credit facilities, are all fit. So it's truly understanding why you need the money. And again, jumping back to the balance sheet, is why don't you have the cash? All of a sudden your debtors have gone from 30 days to 60 days to 90 days to 120. You've got a working cash flow facility there that is 90 days longer than it ever was going to be. Therefore, you've got 90 days of cash tied up in that cycle. So it's truly understanding why you need the money, why you don't have the money to pay the bills or indeed invest in the growth in the business, and then picking the right company that will actually be able to facilitate it. Good thing as well with an invoice finance line, you generally get an IP of between 85%, initial payout of between 85% and 95%. But, the company itself are looking at your debtors and who you're working with and who you're selling with to make an assessment of, the viability of the reclaiming the debt. Also, most personal guarantees are only a small proportion of the invoice finance line, potentially up to about 20%. It also grows with your business. So therefore, if your debtor book goes from 100 to 200 to 300 to 400, that initial payout actually grows with the line of your facility, providing you're not going 120, 150, 180 days, because those will be excluded. So I think it's absolutely fit for purpose for the right business, for the right supply chain and the right product.
Really helpful insights. We're coming towards the end of our time together, so I'm going to turn to Hitesh and then Sebastien, just for your final thoughts.
Yeah, look, from my point, I mean, even what Adrian was just saying there about the invoice discounting thing, for me, the way I view it is, if you have a viable export opportunity or are thinking of doing exports for the very first time, don't be scared. That's my first thing. I say that with 35 years of banking experience only in trade and trade finance. Your bank, whether you're a very small business that is in a call center or a Goliath business, if you are nervous about doing exports, talk to the trade finance person at the bank. If you are concerned about having the cash flow support for that opportunity that you have, try and link in with us and the bank together. Don't be afraid of looping us in with your bank. That's one of the things I should have said earlier, is that quite often the best results that we have had is where you've then had a conversation with the bank manager and the trade finance person at the bank. Loop us in with that conversation, because then we can take off our conversation with them behind the scenes. Yeah. Secondly, as in Adrian's space, we as UK government can also direct people to alternative financiers such as Adrian to be able to get the other solutions for you. Yeah. So my main message is, do not be afraid of exporting. Talk to the right people.
Crack on with it. Grasp the opportunity. Sebastien, you've got 60 seconds.
Challenge. No, first of all, great conversation today. Thank you for the opportunity to meet up with all of you guys.
Yeah.
And I think my message will be really think ahead, adapt, embrace the change. And one thing could be really focusing on innovation, and innovation in different forms, innovation in the way you do things. Processes, new processes can be also a source of innovation. Injecting a new material, a new product, a new way to do things again. So very, very important, I would say, to make sure that we adapt, always adapt, and always do the best we can. And it could be challenging for big corporations, because that innovating, changing rules can have an impact on bottom line. So we're always thinking twice when we're a big corporation. For a small corporation, a small organization, it's a question of life or death. So there's no options. You have to innovate, otherwise tomorrow you won't be here. So always keeping this mind. That would be my message.
Fantastic. A great place to end our conversation today with trying to encouraging everyone to blend innovation with their approach to export. Certainly the spirit we need to move forward in today. A huge thank you to my panel this morning. That was Sebastien Barillot from Whysebird, Adrian Innes from Finpoint, and Hitesh Patel from UK Export Finance. Thank you also to the London Business Hub for their support for making today's webinar happen. You can of course find more post-Brexit support, including the Brexit Ready podcast series at businesshub.london. Finally, just to remind you all that in just a week's time, we will be together again for the very last seminar in this four-part series. We will be joined for a panel that is going to look back over the past three seminars for some of the top insights. We will be joined by Feroz Ghazi, Managing Director at CLS, Barry Bassett, Managing Director at VMI.tv, and also Hakan Henningsen, who's Director for Tax, Customs and International Trade at BDO. And that they'll be particularly bringing a sector-based sort of lens to our discussions around export. As I mentioned earlier, the slides along with a recording of the webinar will be shared very shortly. And if you haven't yet signed up to that last webinar in the series, please contact my colleague Rowan, ROHAN.Gupta, GUPTA, at westlondon.com to get registered for that last webinar. Thank you all once again for joining us this morning. Until next time, have a lovely day and see you soon.